Understanding Methanex, the world's largest methanol producer, is key to grasping the dynamics of a critical chemical commodity and the potential for a cyclical investment.
Methanex, trading as MX on the TSX and MEOH on NASDAQ, stands as the world's largest producer and supplier of methanol. This Canadian-headquartered company plays a pivotal role in the global chemical industry, supplying a foundational building block for everything from plastics and adhesives to renewable energy applications. For investors, understanding this company means examining its commodity-driven business model, which often leads to cyclical stock performance. We'll delve into whether Methanex is currently a cyclical or value play, its business operations, competitive landscape, and the significant challenges it faces in a dynamic global market.
Methanex's core business involves converting natural gas feedstock into high-purity methanol and distributing it globally through an extensive supply chain, including the world's largest fleet of methanol ocean tankers. This model makes it inherently a cyclical play. The company's revenues are directly tied to global methanol prices, which fluctuate significantly based on supply and demand dynamics, as well as the cost of natural gas, its primary raw material. We've seen periods of considerable market volatility, with prices facing downward pressure due to ample supply and shifting demand. Their operational sites span multiple continents, including North America, Chile, Egypt, and New Zealand, giving them a broad reach but also exposing them to regional gas supply challenges. Despite its cyclical nature, analysts currently regard Methanex as a potential value play. As of mid-February 2026, the stock has shown strong year-to-date momentum with a return of nearly 19%. Valuation suggests the company is modestly undervalued. Its price-to-earnings ratio of around 17.7 times is notably lower than the North American chemicals industry average of 23.4 times. Furthermore, an intrinsic value analysis suggests the stock could be undervalued by as much as 35.8%. The company also offers a consistent dividend with a current yield of approximately 1.52%. Its payout ratio is considered sustainable, demonstrating financial health despite market volatility. Methanex operates in a competitive global market with key rivals like OCI N.V., LCI Group, and Sipcam. The company faces several significant challenges. Firstly, prolonged periods of low methanol prices due to oversupply or weakening global demand can severely impact its profitability. Secondly, the cost and availability of natural gas, its primary feedstock, are critical. Gas supply curtailments have caused production issues in regions like Egypt, Chile, and New Zealand. Lastly, operational challenges and reliability at its plants, such as issues with the G3 facility, have led to shutdowns and increased maintenance costs, raising concerns about efficiency. Looking forward, Methanex is focusing on operational efficiency and cash generation. Despite a net loss in Q3 2025, largely due to lower average realized methanol prices, the company's recent strategic acquisitions, including the OCI Global acquisition in June 2025, significantly boosted its North American production capacity. Management projects higher adjusted EBITDA for Q4 2025 and is not planning significant growth capital investments, emphasizing deleveraging. A key catalyst is their commitment to a low-carbon future, highlighted by the recent launch of the UK's first commercial biomethanol bunkering service at the port of Immingham in February 2026. This positions Methanex to capitalize on emerging demand for greener marine fuels. Methanex remains a dominant force in the global methanol market. Its stock performance will continue to be influenced by the inherent cyclicality of commodity prices and the volatile costs of natural gas. However, strategic acquisitions and the push into biomethanol position the company for long-term relevance. Investors will keenly watch its ability to maintain operational reliability and leverage its expanded capacity to drive future profitability in a transitioning energy landscape.
This is GeeseFinance.